bring in one of my favorite guys, Grant, interest rate observer. You know him, Jim Grant, author of 42 books. They got you with a photo. Do you wear a tie like once a year?
May I say one thing? Nice tie.
Nice. Do you like my tie?
Yeah, I like it a lot.
It's Grant Orange. Okay. So much to begin with. I do want to begin with Alan Greenspan in my conversation. Is Alan Greenspan a good guy or a bad guy in the grand pantheon of economics?
Well, I think as a person, he's probably a good guy. I object to what he did as a Fed chairman and the way he thought about money and markets.
What was the single objection to the later Greenspan years?
I think the misconception that he could see into the future and improve it before it came to pass. And that is a misconception shared by central bankers globally. These people are in the central planning business. They have exited the central banking business. Well, yes. I mean, it's been a slide over the course of generations. But Alan Greenspan, came into Washington with the blessings of all people, Ayn Rand, and he left the great favorite of all who favor government intrusion. And that, to me, that's my problem with Alan Greenspan.
Let's go to a piece from last night. I spoke last night to Alan Greenspan at the Bloomberg conference on foreign exchange FX10. He gave us his thoughts on quantitative easing and what we should be expecting from the markets.
In my experience, triggering or dissipating that malaise, if I may use the term, you got to go through a period of boredom, not sparking. You don't spark that. That's not what human psychology, being what it is, whether we like it or not, doesn't get sparked. It gets a gradual erosion of fear, and all of a sudden you start taking little baby steps. And things are moving along well, and you just pick up. That's the way markets behave. I mean, you're not going to change that.
And I'd asked Chairman Greenspan about how do you kindle a recovery, and you heard him say you need a period of boredom. Can the politicians survive a period of boredom to recover?
Journalism can't survive a period of boredom.
We know that. We know that.
What we have in front of us, Tom, is what's called good copy. And I am against anything except good copy.
This is a financial crisis that keeps on giving every day, and you're dead on about that.
I have one suggestion for the improvement of our financial thought, and that is plain speech. Quantitative easing is one of these PhD-approved euphemisms that doesn't really convey the essential point. Money printing would be so much a better step in the direction of intellectual hygiene. I mean, these people talk about quantitative easing as if they didn't mean to debase the currency over which they have temporary control.
It's almost medical. Let's look at the monetary base here. This is the dreaded first chart that we have here. A shrinking monetary base. So this is a narrow view, folks, going back to October of last year. Chart is well known. We roll over. You're going to be able to see it. There it is, Jim. You can see it up on camera 2, camera 3 monitors there. And we just sort of quietly rolled over. I thought we were going to float away on a wall of debt. Well, here we are. We've rolled over off $2 trillion. Now they want to put more on that, right?
I think that chart tells us nothing about the future. And what we think we know about the future is their collective intention to do much, much more money printing. You've heard from the presidents of the New York Fed and the Chicago Fed, Chairman Bernanke himself.
These speeches today,
yeah. I mean, a couple of days ago. The one by Bill Dudley, the president of the New York Fed, I think is especially notable. In it, he said that he personally was dissatisfied with inflation rising over year by 1.5% and prefer something along the lines of 2.5%. Now consider what he thinks, A, he can measure, and B, what he can affect through the means of money printing.
Right.
The great Friedrich Hayek called this the pretense of knowledge, whereas we in Brooklyn say, huh? Oh, yeah? You can do that? I mean, I think this is what these currencies are grounded in is not the traditional collateral gold and silver. They're grounded or collateralized in the market's confidence in the analytical acumen of the people who manage them. And these are the people who saw exactly nothing of this great cyclone of 2006, 7, 8 until it was upon them. And even then they doubted it. And now we are meant to. I'm only getting going now, Tom.
Well, we're going to come back. We're going to come. Jim Grant with us. With me, Neal Soss. He is chief economist, Credit Suisse with us. And Jim Grant, we've been talking to, Grant's interest rate observer. There's so much going on here. Is QE2, Neal, is it just printing money, as Jim Grant says?
It is that, and it's more. One way to think about this is that from the Fed's balance sheet perspective, if they add assets, they have to add liabilities. Those liabilities are reserves. They are the base of the monetary system in this country. They are money. That's the printing money part. I think the Fed is not really focused on that. I think they're focused on a different transmission mechanism to the economy, and that is a kind of portfolio effect. They make treasuries either so rich or so scarce that investors have to buy, so to speak, other things. And I think, although they wouldn't be able to say it quite this way, I think they're focused on pushing down the dollar, good for exports by itself, and then forcing other countries to have easier policies to offset that.
Your fall conference sells out in about 3 minutes with elites of Wall Street. Your title this year for your part of it is Bonfire of the Currencies. I mean, it's a weak dollar to salvation again, isn't it?
Well, the weak dollar is the centerpiece of our monetary world, but it is joined by weak other currencies, weak not in relation to, well, weak and especially in relation to gold bullion, which is that currency that is mute. It can't object to its going up. No other manager of a currency wants the old maid of money. The old maid of money is a strong currency. A strong currency is nominally bad for export growth. In a world of disappointing large economy growth, people want their exports up. They want growth rates strong, so they want a weak currency. So the United States, however, the United States dollar is the world's reserve currency. It's meant to be a store of value.
And we've been showing here this week, folks, dollar. I want to go to too much information, Rex. And this is another way to look at it, folks. Neal and Jim, look over here. Here's Singapore dollar back 80 years. Larry Cantor, Bob Sinch, and Jens Nordvig yesterday making a big deal about the Singapore dollar is the most appreciated currency. Down is a stronger Singapore dollar, folks. And Chinese renminbi right behind it over the last year. I mean, this is the pain of Asia. They're saying they've done their fair share. Has Asia done their fair share in currency appreciation?
I don't think it matters. They're going to be asked to do more, and if they want to resist it, they're going to have easier policies than their economies otherwise would justify. That means perhaps easier interest rate policies because you've got to offset that strong currency, easier budgets, easier something, and that's being forced on them.
You know how this works? Okay, so Singapore in the second quarter grew its economy at the annual rate of 19%, 19%. Extraordinary. And what is a suitable interest rate for a 19% growing economy?
Something higher.
Well, they have about 1% as the basic money. The Singapore Monetary Authority targets the exchange rate. It resists its undue appreciation. The way that these Asian central banks resist is to accumulate dollars, let me finish, with currencies they themselves print, especially for the purpose. So what our weak dollar means is a worldwide gurgling up of this essence called liquidity, which means rising markets, which means the Fed is back in the business of manipulating expectations, prices. And is that central banking or is that something else? Or is that what we call a brokerage business?
Is it a mercantilistic? I mean, it's obviously elements of mercantilism, but if you have an Asia playing by their rule book, how do we presume to tell them what to do until we get our house in order? Do they need to see signals from us before they'll play along?
I think we need to get our houses in order simultaneously. You can't get the U.S. trade deficit to go down in a vacuum. There has to be somebody on the other side either absorbing our exports or alternatively absorbing their own output rather than selling it to us as our imports. And we've been talking about this for decades, frankly, as the issue of the global imbalances. This helps to force the issue.
Point now. We have been talking about this for decades.
25 years.
Well, you've been calling tipping point forever, but is there something new about the end of 2010?
Yes, there is something new, and that something new is the seemingly global consensus that currency should be weakened against gold. They don't say that, but there is a determination on the part of the Bank of England, to judge by the speech of Mr. Posen. There's a determination on the part of the Bank of Japan, on the part of the Fed, certainly, on the parts of many other central banks, the Swiss, even the Swiss, to weaken their currencies against some marker they themselves set up. If nobody wants a strong currency, that means, I think, that investors ought to be looking for stores of value, not denominated necessarily.
Yeah, and here's Hildenbrand of the Swiss National Bank saying global recovery remains fragile. Let's do the number. Larry Cantor over at Barclays. Neal, he estimated in our panel yesterday, QE2, or Jim Grant's printing money 2, right now priced into the market roughly $700 billion. Is that a number you can work with, or do you think they'll do shock and awe? It's Friday. Shock and awe, or will they do a sequential rollout?
Well, I think that from their point of view, they're better off retaining the flexibility that a sequential process gives them. So instead of 25 basis points of interest rate being the standard unit of monetary policy adjustment, as it's been for some decades, now it might be $100 billion of balance sheet. But if they announce $100 billion, let's say at the November meeting, they leave themselves the flexibility, but the market will multiply that by 8.
That's my point. The game theory, they're not making the rules right now. The market's making the rules right now.
Well, they opened the door for that.
That's true.
Well, this gets us back, I think, Neal. It gets us back to the years before 1951, when the Treasury and the Fed were one institution in the business of manipulating interest rates to fund the wartime and post-war
And essentially
deficits.
McChesney Martin stared down Truman, is my recollection.
Correct. I was only a trainee. I can't remember. But
I can't either. That. Neil Cameron.
But notice this whole Fed independence thing is I think it's a chimera. What the Fed is talking about. They're talking about doing it. They're talking about about pegging yields. And in fact, Mr. Bernanke and Mr. Greenspan were talking about that in 2002.
Barry Eichengreen, Berkeley, the giant on capital flows. Here's his foreign policy piece from a bit ago. Financial shock and awe. The Fed needs to stop dithering and make precise the extent of quantitative easing. Is this a point where they just got to come out and do it, Neil? Or can they keep a schedule that gets us to December?
Well, I think from the point of view of the way markets have priced themselves, there is a considerable risk of a very damaging market disappointment if they don't come across now at this November meeting.
Do you agree?
Yeah, I mean, everyone's saying the same thing. Everyone's saying the same thing.
When you have 2-year notes in the 30s of basis points and 5-year notes about to cross the threshold of 1%, you've priced in a fair amount of Fed buying of those securities.
But notice as this talk of deflation intensifies, look what's happening outside the Treasury bond market. Stocks are at new recovery highs. These commodities are flying. Silver is like a $24 item.
Right.
I mean, and the dollar is bid wanted in the world. So is this exactly deflation? And who are they? They are monetary mandarins to tell us. I mean, this is, I think it's an extraordinary episode in monetary.
We're going to come back. Jobs. We had a jobs report today. We've been talking here about, what'd you call it? Printing money too?
Yeah, money
it's
printing.
Brilliant.
Yep.
Jim Grant and Neal Soss with us. Neal, a jobs report difficult. I want to bring up my pain chart here. Rex, bring up chart number 5 here. It's the worker who lost out. That's what Jim Glassman told me this morning on Bloomberg surveillance. Median duration. It's a medical chart. It's like something you'd see in Grant's interest rate observer.
Yeah.
That's not jargon, no. Structural versus cyclical. How much of this crisis of 17% underemployment is structural versus cyclical?
I think that more and more of it is structural, and what is cyclical becomes structural with every passing month that people remain further out of work.
First person I heard say this, you said long-term unemployment is just a new form of welfare. Do you stick with that?
Well, that's not a good thing. It's just a fact.
No, but the phrase, it's shocking.
It's just
People
a fact.
get upset when I say that.
Well,
Neal Soss said that.
Well, they shouldn't. They shouldn't. They're acknowledging the reality. We're not going to let these people starve. They are our fellow citizens. But if they're out of work for long enough, it's a little hard to think of it in the traditional sort of cyclical, temporary layoff, recall, unemployment insurance context of the past.
Fold the labor economy into your work. You talk more about interest rates and Fed and that. I mean, the Fed at the end of the day, they've got a jobs mandate. I mean, people have said this. Greenspan early in the decade was about jobs.
They do indeed have a jobs mandate. It's interesting to go back and read the original 1913 Federal Reserve Act and see what is not in it. Then what the founders intended was the Fed to be an instrument of cyclical accommodation for a banking system that needed liquidity at certain moments of the cycle or of the season. And the idea was not to change the yardstick to accommodate changing circumstances in our economy, but rather to keep a steady a fixed yardstick, but to offer intermediate forms of liquidity. That's all out the window. The founders of the Fed would have no comprehension of what this outfit's about now. None.
State and local jobs you mentioned. Ugly. Harm Bondal said the same thing at Unicredit.
Yeah, no, this is an absolutely remarkable development. When you think about it, again, whether you justify the Fed's involvement in this way or not, it's illustrative of why they seem to be so concerned. We have had a loss of state and local employment, which is more or less without parallel. I certainly can't find anything like it. And just illustratively, 1 out of 7 people who gets a paycheck in America is a state and local worker.
That's a factoid of the week. That is the fact. 1 out of 7?
1 out of 7. And half of them being school teachers, as you might imagine. And the loss of jobs in that sector now has offset something on the order of a third of what private sector job rebound we've been able to get.
I want to get this chart in with you, too. Jim Grant, this is a Jim Grant chart. Yield famine, the 5-year note, as Neal said, going under 1%. How are we going to reverse this trend? Jim, I'm going to give you the last word.
Well, it's going to happen. I mean, look back to the beginning of this great bull market in bonds almost 30 years ago. People said, how would we ever get yields below 15%? It seemed impossible. And here we are at the end of a very long cycle. And now the question is, how will we ever get interest rates you can see without bifocals? But it will happen. Notice that we are worrying about, you need stronger glasses. We are worrying about invisible interest rates at a time when the world's central banks, as if in a cabal, are promising us they will print money until something happens. So
thank you so much for coming by. I know we could go forever. Jim Grant, Neal Soss, thank you so much.